morning everyone. So today's topic is basically about the volatility defense and risk management and how to handle the portfolio resilience. So today we have wonderful guests. We would like to understand everybody must be taking care of their own portfolio right now, but so many things are happening in the market. So we have the experts who are going to provide us the insights about how to maintain their portfolio. So I have a question for Mr. Rohan Sonavne. What are the key principles should every trader prioritize in risk management?
See, when I talk about the risk management, I'll say one thing. Like we often seen like a successful trader saying that we are making a consistent profits every day, but what we never heard like losing money in the market, because the first thing they do is that they protect their capital wisely, and that initially comes from the one important thing, that is foundation of the risk management. When I talk about something which is more important, when I say risk management, there are two important things. One is like the diversification of your portfolio, or maybe diversifications of your assets. Like if you rely on a particular market all the time, it is not going to give you any kind of support. It will always be running into a loss factors more. And the second thing I will say, that build a portfolio. Because today, as we see everywhere, like people just say like we are making profits. This is today's generation. But if we go back to our, like at my dad's age time and all, we see people saying that my portfolio is performing. Because whenever you have invested in multiple assets at a similar time, your portfolio will be stable in the market. And that will not only give you a stability, but it will also give you like a lot of, I can say, opportunities. Because today we can see everywhere there is political events, technical factors, fundamental factors everywhere. So risk is involved everywhere. So these are the two important things. One is like you diversify your equity in the market wisely and focus more on building your portfolio. That will definitely help you to build a strong foundation for your risk management.
Okay. So basically to manage the risk, you have to diversify your portfolio. That is what you are trying to say.
Right.
Okay. So I would like to ask on behalf of the audience the second question from Mr. Siju. Do you think hedging is practical for the retail investors and traders, or is it only a portfolio?
Absolutely. I think anything that's available for institutional traders should also be accessible to retail traders. And I think what myself and some of my colleagues on this stage have been doing is providing the same level of access, the same level of tools for the retail market, just as much as the institutional market. So in terms of hedging, right, the way I think about it is there are proper ways to hedge. For example, if you're trading equities using options or something like that, or correlational. So if you're trading gold but you want to hedge, you can do it via, for example, Australian dollar or Canadian dollar against oil, something like that. But in retail, what I see sometimes, the pitfall to avoid, I would say, is they call it hedging when it's not necessarily hedging. Right? So we have clients, for example, ask us, oh, can I do hedging on my account? What they mean is, can they go long and short the same currency, right? Now, interestingly, some regulators do not allow this, right? Because sometimes all it does is assure that you lose, right? It just ensures that you pay double the spread and double the commission and you don't walk away with it. So when we talk about things like hedging, you have to make sure that the terminology and the definition is correct. So to protect your downside using the instrument, using other instruments, absolutely, it's available. Again, most of us up here are also multi-asset brokers, so you can trade across different instruments. So if you know what the correlation is, absolutely, it's there. Absolutely take advantage of it.
So only the professionals can take the advantage, or the retailers would also be able to use those hedging instruments?
Absolutely. It's available. It's widely available. So again, it's understanding what's available and how to use it, right? So the reason I was mentioning the pitfall of simply just going long and short, because if you're talking to someone, they say that's how to do it, you're listening to the wrong person.
Okay. Now I would like to ask the question from Mr. Bhavin Shah. What should traders or investors do during the volatile markets?
So I think, basically, when we talk about audiences in our industry, there are two segments and two types or category of participants, which are traders and investors. And for both of them, the ball game perspective and the objective for everything is very, very different. So what happens typically that even today, if we go to see unfortunately, when we see participants entering into the stock markets, enters with a quick money making perspective that when there is a lot of fancy in the markets since COVID times we have seen, but we were always fearing one situation, that all the participants or the new entrants who have entered since the COVID times, in last 6 to 8 months they have seen the other side of the market, how they have been. Otherwise, if we go to see, since COVID times, 1 रुपए का 4 रुपया ही हुआ है मार्केट में, घोड़े गधे सब चले.
Very true.
Right? Even if there was a by mistake, wrong trade you would have taken, you would be making 10-20% even there.
That's true.
Right? So what typically happens is, for traders, I would say the most simple thing, everyone sitting here in the audience would 110% be aware of, but how many really, when you take a trade as a trader, you follow is very important. Now what typically our observations or experience has been, that if I am entering as a trader, I am very well aware about a target price and a stop loss, right? Because it's a trading bet and not an investment bet. So what typically happens that, fortunately, if you are fortunate and lucky enough, your first trade, second trade probably is nearing the target price, you will probably book 80% or maybe book little before even the target hits, कि एक बार निकल जाते हैं, target के पास आ गया है stock, you know, अपना trade. In the second scenario, so you are sticking to following that one principle of making sure that you want to, at the target price which is decided or which the indicator has given you, you are trying to book and exit the trade. But in most of the scenarios, when your trade is getting closer to the stop loss levels, you tend to not follow that and kind of wait. It will further go down, then you'll wait, it will further go down, and then what will happen, that you will wait, यार मेरा भाव आ जाए मैं निकल जाता हूँ.
That's true.
Right? Because the acceptance of that loss is not there. So what is happening typically, on the profits you are booking it, on the losses you are not following. So here what I am trying to communicate is that having that discipline of following both the levels, only then you will see that 60, 70, 80% strike ratio of overall trades. Otherwise you will not be witnessing that yourself. So this is the most simplest and the most common rule, that as a trader stop loss तो follow करना ही है. Because वो time पे आपको ये लग रहा है यार ये loss हो गया, loss हो गया, loss हो गया. I am not able to accept the loss. It is part and parcel of the game. That's the nature of the trade. And for investors, it is more that volatility management comes typically where you have, like Mr. Rohn also mentioned, that the diversification is very important. And that is where, because see, all the asset classes or instruments are not going to perform at the same time. So what happens that, how much percentage to do, it all depends case to case. But largely, if you are diversified well enough, even if you don't have any access to any advisor, which is not the case. I mean, there are n number of advisors and wealth managers and financial investment managers available. But even if you don't have, even if you by thumb rule go 100 minus your age, equity debt भी कर लिया, तो भी you are pretty much sorted. At least वो आपका 100 का 100 पूरा का पूरा रुपया equity में नहीं जा रहा है, right? So because all the asset classes are going to perform at a different stage of time. So hence, if you are kind of diversified, at least to some extent, you'll be able to beat the volatility in sometimes. Because if equity is very volatile, probably you'll be losing money at that age, but probably a debt or a gold instrument might be making up something for it. So I think these are the two rules one should really keep in mind.
So what I can understand from your perspective, so people used to, wait for the losses and they don't take it.
Right, right.
And I also think like people used to do the averages also, which
Correct.
creates a very
Correct.
difficult scenario for
Absolutely.
the people.
Absolutely.
Nice. And a part of that, I would like to ask a follow-through question on the same.
Sure.
Like how a person should take care of their portfolio while it's bleeding. So what should be the perspective, what should be the mindset of a person to take care of their portfolio?
So see, now as a fundamental rule, what becomes very, very important is that while you have taken a trade, I'm talking largely from an investment perspective, because end of the day, आप trading भी mindset वाले हो या आप trading भी करते हो, end of the day I say that आप trading में जो पैसा कमाते हो, थोड़ा बहुत नसीब से ज़्यादा कमाते हो, आप वो trading में जो भी पैसा कमाते हो उसको साइड में कीजिए और उसको investment book build up कीजिए आपकी. And that is how eventually you'll be able to build up your own personal wealth and quality portfolio. So now what happens that purely from investors' perspective, if see there has been multiple events and incidents where we've seen markets correcting, falling down, मतलब overnight आपको मतलब कुछ अंदाजा ही नहीं भाई क्या हो गया, and such times if there is a consistency, there has been correction happening, my portfolios are bleeding, यहाँ पर ही वो चीज़ फैक्टर इंपॉर्टेंट आ जाती है कि जब आपने वो इन्वेस्टमेंट स्टॉक लिया था तब आपका ऑब्जेक्टिव, आपका टाइम होल्डिंग पीरियड और आपका रिटर्न एक्सपेक्टेशंस क्या है. एज फार एज यू आर कन्विंस्ड अबाउट द स्टॉक आइडिया, स्टिक टू इट. यू विल गेट अपॉर्चुनिटी, कीप एडिंग टू इट, राइट. बिकॉज कोई एक्सटर्नल फैक्टर से वो कंपनी के डायनामिक्स चेंज नहीं अगर हो रहे तो यू कैन स्टिक टू इट. I'll give you a small classic example. During pandemic, when there was a sudden correction of 7,000-8,000 points of Sensex in a span of about 8, 10, 15 days, Tata Motors, for example, was suddenly available at a 64 rupees.
62
right?
rupees, I believe. Yeah.
Correct? उसके exact 1.5 महीने पहले 250 रुपये में अवेलेबल था, एंड वी वर टॉकिंग कि यार टाटा मोटर्स तो 250 रुपये में कुछ है ही नहीं, लेना ही चाहिए. ठीक है. अब पैंडेमिक से टाटा मोटर्स को क्या फर्क पड़ गया? वो 6-8 महीने शायद वो स्लगिश चलेगा, सेल्स स्लो होगा, उसके बाद तो पिकअप होना ही है. करेक्ट. वी वर लिटरली टॉकिंग एंड इंटरैक्टिंग विद इन्वेस्टर्स. 64 रुपीज में तो पेट्रोल भी नहीं मिल रहा है 1 लीटर का, आपका टाटा मोटर को शेयर मिल रहा है, आंख बंद करके लो. राइट. सो नाउ एट सच टाइम्स इफ यू हैव अ कन्विक्शन ओवर योर स्टॉक और एनी म्यूचुअल फंड स्कीम से फॉर एग्जाम्पल, और एनी प्रोडक्ट दैट यू हैव इन्वेस्टेड, stick to it, right? Because unless any external factors is adversely affecting the company or a sector, then of course that review has to happen and then you take appropriate calls. So I think if you are seeing bleeding your portfolios, stick to it. If you are convinced about the idea, if you are convinced, if you have the conviction over your stock or your portfolio, stick to it. You are getting the opportunity. आज कैसा है कि सेल में शॉपिंग जाना है, मेरा बजट तो उतना ही रहने वाला है, लेकिन 4 चीज़ के बदले में 5 शर्ट लेके आऊँगा.
So you have to believe on the story of the company.
Yeah. Yes. Yes.
Nice. Now I would like to ask the question from Mr. Rahul. Rahul, how a traders or an investor should take care of their position sizing?
Okay. So basically, I will tell you one thing. As I am trading in the market and people are trading in the market, market is exposed to so many things. If you are trading in the market, it's there are risk of economic data, geopolitical news, or investor sentiments. So the only thing which I think as a trader is on our hand is how efficiently we manage our risks. So we don't know which like either the market will go upside or downside. We just predict the price at the particular zone. We will take a buy from here. We will set some stop losses depending how much risk we can take. To be honest, it totally depends upon the person and the amount of money they are trading with. So ideally, it is suggested not to risk more than 2 or 3% of your capital in a single trade. Every time you are entering the market, you need to plan that I can lose this much of money. If you will trade, treat trading as a gambling, then you will end up losing the money. If you want to stay for a longer run in this industry, you need to treat it as a business, to be honest with you. So basically, whenever you are entering a trade, just decide I will take a buy from this particular price and this much risk I can take. Percentage wise 2 or 3%. As per that only you can decide total number of lots. You can trade in specific commodity or currency pair or even stocks as well. Yes.
So I believe basically you want to say you have to take care of your risk reward ratio.
Yes.
To maintain the portfolio.
Exactly. The only thing I believe is in our hand is how efficiently we manage our risk in the market, because we don't know if there is some news in the market. Suppose if there is any war news or any CPI, any financial news, we cannot predict the market will go upside or downside. But we can protect our equity by putting proper stop loss in the position we are taking.
Nice. Yeah. Rohan, I would like to ask one more thing from your side.
Yes.
Why is risk management often ignored until the traders face a huge loss?
See, for this, I'll give you a basic reason for this, okay? As every trader, like for an example, if I'm a trader, if I'm entering the market, the first thing I will make my proper setup. I will look at the technical factors, fundamental factors, everything. But the biggest mistake what I feel like is your emotional decisions. because trading is not something about technical or fundamental factors. It's all about a mindset. Like when I talk about emotional decision, that comes with many basic things like a greed. मतलब ये ऐसा हो जाता है कि आज अगर मैं पैसे लगाऊँ तो मुझे पूरा उसका 100% प्रॉफिट आज ही चाहिए. दिस इज़ वन थिंग. सेकेंड थिंग, कभी कभार क्या हो जाता है कि एज मिस्टर भाविन सेड, लाइक स्टॉप लॉस इज़ वेरी इंपॉर्टेंट. इट्स वेरी इंपॉर्टेंट. आई एग्री दैट हमें मार्केट में पैसा नहीं देना है, हमें मार्केट से पैसा लेना है, एंड दैट्स राइट, फॉर दैट वी आर ट्रेडिंग. बट व्हेन आई टॉक अबाउट स्टॉप लॉस, इफ यू डोंट प्ले स्टॉप लॉस, in most of the cases what happened, when you have a certain equity of 30-40% इक्विटी जब मार्केट में आपकी लॉसेस पे जा रही, आप तब एग्जिट करेंगे एंड देन यू विल फील रिग्रेट कि इसको मैं काश पहले किया होता. सो आई बिलीव कि मार्केट पैसा देगा भी, मार्केट पैसा लेगा भी. दिस इज वाई इट हैज़ प्रॉफिट एज वेल एज अ लॉसेस. If it has only had a profit, I think everyone in this world right now was a trader. But we need to understand one thing, that whenever we enter the market, it's not all about, again I will say, we have to trade every day. Trade at the right day. The basic mistakes I can say, one is your emotional decisions. Second thing I can say about the leverage. Like I have seen many of people coming and asking like, what is the maximum leverage? So I am little bit curious because I also had a bad experience in the market from what I have learned today. So I'm still on a learning process and I want everyone that to make some money rather than losing. When I talk about leverage, see, आप अगर आपके पास 100 रुपये, 1000 रुपये, 2000 कोई भी अमाउंट हो, अब लेवरेज लेंगे, ऑटोमेटिकली आपका माइंड ये कहेगा कि मुझे और क्वांटिटीज़ बाय करनी, और क्वांटिटीज़ बाय करनी. हम ये सोचेंगे कि जितनी क्वांटिटीज़ बाय किए उतना तो हमें प्रॉफिट आ जाएगा. बट व्हाट इफ अगर मार्केट रिवर्स हो गया तो उतना ही जल्दी आपका अकाउंट लिक्विडेट हो जाएगा. सो दिस इज़ वन थिंग. एंड द इमोशनल डिसीजंस आई कैन से, leverage I can say, as well I can say talk about the stop loss and take profits.
So I believe what I can sum up with your context, if somebody wants to take care of their portfolio or their trade setup, if they can use the technology where they don't have to take care of their emotions, they'll be able to get the best rewards.
Yes, because emotions will play all the time. As my colleagues were saying right now, that whenever we place a trade, we wait that okay, loss cover hoga. That is the emotional decision we took. But practically, if I was a trader, I would have kept my stop loss. Yes, okay, आज मेरा stop loss हो गया, मैं market से exit कर दूँगा.
Revenge trading should not be there.
Revenge trading, yes, I was about to say that. And one thing what I have seen कि आज अगर बड़ा loss हो जा रहा है, so मैं उसका into 3-4 times extra quantities लूँगा and I will hold it so that I will make money instantly. I don't want to have a sleepless night by losing money in the market. And there itself, what we do, like what clients are doing, traders are doing, putting like investing their money, hard-earned money in the market and giving it them for free. So this is something very important, I will say, in the trading history.
Okay. Bhavin, I want to understand, like, what is your experience while dealing with the clients or, like different sizes of portfolio, when they tend to miss out or get ignored for due reason? So what is your experience on that?
So I think very valid question, because that's what day in and out what we keep dealing with, and try to keep educating investors, because so I'll give you a very classic example. 3 years back I happened to meet one of the investors and we were trying to discuss around how to build and construct the portfolio. He already had a very large portfolio. And our thought process is also always one thing, that you allocate your fund. अगर समझो 100 रुपये आपके पास है, 10-20 रुपये से आप ट्रेडिंग करो, keep dabbling into the markets, opportunities मिलती है, we don't want to lose out on opportunities. At the same time, another piece of ideal funds has to be built on quality portfolios which you can rely upon, and you can create wealth in the longer run. What typically happens that we get swayed away when we keep coming across with people and investors कि end of the day सवाल एक आता है, it's an Indian mindset, भाई इसमें return कितना मिलेगा, ठीक है. अब you will always have a comparative analysis that I would be there as a product guy, he would be there as a product guy. इस सर बोलेंगे कि इसमें आपको मैं 12% देता हूँ, I would say मैं 11%, 14% देता हूँ, and so on, how things and our universe works. But what typically we try to educate, that to go behind that extra 1 or 2% of returns, how much underlying risk are you taking, right? Because we always keep talking about risk and reward ratio, right? So 1:2 है, 1:3 है, ट्रेडिंग एनवायरनमेंट में रहता है, इन्वेस्टमेंट पर्सपेक्टिव में रहता है. बट यू नो व्हाट हैपेंस दैट यार वो तो मेरे को 14% बोल रहा है, उसमें तो मुझे 14% मिल रहा है, अब चलो मैं 13% देता हूँ फॉर एग्जाम्पल. बट लेकिन फॉर दैट 1% एक्स्ट्रा रिटर्न, what is the risk that you are inheriting?
You have to take care of the CAGR, like how it is going.
And end of the day, what happens that I always try to educate, and I've asked this question to a lot of my one-to-one discussions and in the forums, that are we aware about a thin line difference between risk tolerance and risk affordability?
True.
So normally when I deal with to answer your questions, यहाँ पर एक बहुत बड़ा difference है, बहुत छोटा सा है but बहुत बड़ा difference है.
Very thin line.
Yeah, मतलब if my investor might be in a situation to afford losing a 30% of his capital, right, but not be able to tolerate even a 10% of drawdown on his portfolio, then that is what matters, right? Because मैं afford कर सकता हूँ but I can't tolerate seeing my portfolio going down even by 10%. So you have to factor in all these things. These are the typical things कि I can afford but I can't tolerate. So then what should be the case? You try to construct a portfolio keeping a lot of factors in mind, like liquidity is the key. COVID ने सब लोग को liquidity का importance समझा दिया है. वो ₹1 का वैल्यू ₹2 था, जिसके पास कैश और लिक्विड पड़ा था उसका वैल्यू ₹1 का वैल्यू ₹2 था. So now these are the important things that while you are investing into any instrument, any product, any opportunity, you have to keep in mind whether the fund is liquid available, how much are you putting into a lock-in scenarios, and the cost implication. So ये सारी चीज़ें बहुत मायने रखती है, because अगर आपको ज़रूरत पड़े उसी टाइम पे अगर आपको फंड्स या आपका इन्वेस्टमेंट काम नहीं आता है, then what is the point? So how much percentage you are allocating to which asset class is very important.
That's true. Rahul, I want to understand, can you share one experience, personal experience where trading, where strong risk management saved you?
Yeah, so personally what I believe is like this thing happened with me so many times, not one experience. I remember last year I was trading in gold. Mostly I trade in gold only in forex market. So there was news of NFP. So I am trading with my colleagues in the office setups, and what we do, some people are using stop loss while trading the market, and some people say it's news time, देख लेंगे ऊपर जाएगा तो hold कर लेंगे, नीचे जाएगा तो average कर लेंगे, ठीक है. तो what I did, I put the stop loss, and at that particular day I remember market fell down after the news 100 points, $100. Market $100 जैसे drop down हुआ, जिसका stop loss लगा हुआ था उसने छोटा loss accept करा. So basically stop loss is a protection against your equity. That's it. ये loss नहीं है, protection against your equity. तो जिनका मेरा stop loss hit हुआ, I was like out of the market with a very small loss, and I was preparing for the next trade when there is a right setup. But all the people who were waiting कि ऊपर आएगा तो average करेंगे, they end up losing more money and even wash out their equity. So I personally believe कि it's very important कि अब जब भी trade कर रहे हो market में अपना stop loss लगाओ and trade with proper plan, because before entering the market अगर आप इसको without stop loss खेलोगे, it's not trading, it's gambling.
To sum up, you mean to say like you have to take care to ensure to keep the stop loss in every trade?
It's very important actually. It's your own money, hard-earned money. You are trading in the market and it's exposed to so many risks. So it's very important to keep the stop losses. Before entering the trade, we don't know market will move which side. So एक चीज़ ये भी होती है कि when market is moving in the wrong direction of our trade, we will start holding the trades. But जब market हमारी direction में move करती है ना 10%, 20%, before hitting the TP, we will book all the profit जल्दबाजी में. तो लॉस लंबा ले लेंगे और प्रॉफिट बहुत छोटा एक्सेप्ट करेंगे. एट द एंड ऑफ द गेम वी विल एंड अप लूजिंग मनी.
So if I could understand, less trades can help you to be more profitable.
So there is a saying in the market, the less you trade the more you will make the money. तुम जितने मार्केट देखोगे it will like give you the excitement to take one more trade. It's better to be disciplined, to wait for the right setup before entering any trade in the market.
Siju, I want to understand from you how a trader or investor should take care of the global events like the interest rate cuts, unemployment data, and many more other factors. So how to take care of that factoring into the market while trading or investing into the market?
Sure. So when you look at our website, and particularly our research website, the most popular section of the website is the economic calendar, right? And I think actually for all brokers and other third-party sites, this is often the most heavily trafficked website. And for us, we show per event the impact. Is it a high impact event? Is it a low impact event? You know, Rahul earlier was talking about NFP. Everybody knows this is a high impact event. But if you look at the economic calendar, there are literally hundreds and hundreds of events coming up. You have to try to figure out what is the noise versus what's not, right? So I think using tools like an economic calendar, these things are completely free of charge. And most of them will also, again, frame it by impact, high impact versus low impact. So it's good to take a look at that to see what's coming down. But at the end of the day, you know, this conversation between trader versus investor, right? So as an investor, of course, if your investments are interest rate sensitive, you want to see what the direction is. But otherwise, you may not be as sensitive to it, right? So again, to what Rahul was saying earlier, what did you say? The less trades you make, the more money. I've been in this business 25 years. The single most profitable client I've ever had was a global macro fundamental trader. And when I used to call him, he used to tell me, you know, Sidhu, I'm not that profitable a client for you because he traded once or twice a year.
Oh.
You know, his average holding time was 3 or 5 years. So, and again, interestingly enough, you know, the clients who are trading a lot, they make the broker a lot of money, but not often themselves. And so, because his trading style was a macro fundamental trader, he looked at, you know, the events that were coming in. But he used to tell me, I don't even log into the account that often because I don't want the temptation of putting on additional positions that I don't need, right? I think the follow-up to that is there are so many events of volatility, right? So the first question you asked me was hedging, retail versus institutional. This is where I draw the line between retail and institutional, right? So I think these high-impact events, if you're retail, that's not the time, right? I often tell our clients, when you have high impact news hitting the market, stay away from the market for the first couple of minutes, right? Because there's 3 positions you can have. You can be long, you can be short, or you can be flat. Yeah. It's better to do so because at the institutional level, you have high frequency trading firms that have enormous advantages, right? Before the number is printed, they're already out of the market. So that's when you blur the lines between trading and gambling, right? So be aware of what's going on. Avoid those high impact events, I would say, for a minute or two. And I think some brokers mandate that. And that's how you can take a very reasonable and rational approach to economic events.
So basically, even like those economic events, I want to understand one more thing on that, on top of that. Like, how do you take care of those events are impacting which asset class? So is there any way to find out those things practically?
Again, research and analysis on that, right? So again, if you have interest rate, that's probably the easiest ones to look at. But if you look at something like non-farm payrolls, right, you can see that's the most high impact event. It's the US, the number of jobs added in the year. Obviously, anything dollar-based is going to move. But like I said, there are so many researchers out there that will tell you specifically. Now, that's why there are research analysts and banks still farm that out as soft dollar sales, right? So I think as a retail investor, it may be difficult for you to extrapolate what that means and how it impacts your portfolio, but there's so many free resources out there. And that's where I think when you get into a very beyond the economic events, right? For example, if you're particularly into an equity, like let's just say defense stocks, for example, and who's getting awarded contracts, things like that. So I think there's so much news out there today, but at the same time, there are so many resources. And again, they're free, they're online, and you can easily avail them.
Now I want to ask the question from each one of you, like what is your perspective? How important is to take care of your asset allocation in different type of instruments? For example, like equity, commodity and other things. So what is your point of view on that?
According to my point of view, I will never invest my 50% of my capital in any markets. The best thing I can do is like I will invest 5 to 10% of something in commodities, indices, stocks and cryptos. Because I believe that today the market is not in a bull direction or not in a bearish direction. It can fluctuate anywhere because every day we are, as if I talk about a forex market, we all know like Trump is coming every day saying something else and the market is getting volatile, many more things. So I will invest initially 5 to 10% of my equity into particular markets, and according to that, if I see if market is going opposite to my side, of course it creates a new opportunity for me. So that will how it will work in a proper way where we can diversify the equity assets in a proper in a risk management as well.
So you mean like different asset classes should be taken care of while doing your portfolio diversification?
Yes, right.
What is your opinion on that?
Similar, I think diversification is key, but at the same time, if you diversify too much, you may diversify away your returns, right? So every year, I think I bank with HSBC, and they keep sending me this risk questionnaire. And I think as I get older, the results keep changing, right? Because of course, at a certain age, you're looking for more risky assets, and towards, I guess, retirement, you're looking for capital preservation. But one of the things I hear today is all the people who thought, oh, I missed out on crypto, for example, right? So even if you didn't believe in it, right? If you allocated a small percentage of that, today you would be much happier. So I think, obviously focus on the things that you understand, focus on the things that make the most sense for you, but gain some exposure. So going back to that earlier client that I was referencing, he traded with me for maybe 5 or 8 years, extremely profitable investor. And then suddenly one day, he called me up and he said, what is the account minimum? So why? What happened was I thought it was service or something like that. And he said, no, he's like, I follow super cycles. And he said, I feel like the next super cycle is going to come into commodities and I'm shifting to that. So out of 100% allocation, he's just moving based on what he's seeing. And so if that's what I'm seeing out of some of the smartest investors, then I think the rest should follow suit.
Can an investor or a trader time the market, as you said about the super cycle? So do you really think so?
I wouldn't be on this panel if I knew how to do that. I think timing the market is probably what do they say? Don't catch a falling knife, right? So it's like if you try to time the bottom of the market, I know you were talking about Tata Motors and such, like, does it matter whether you got it at 64 or 74 or 84? Like, I think timing the market is one of the most difficult things. So if you can just follow the trend, right? What do they say? The trend is your friend. Then I think you're much better served.
True. Rohan, what is your perspective on the same?
Basically, what I believe is there is one more saying in the market, then don't keep all the eggs in one basket. So it's very important to diversify your portfolio. Even for me, if I'm trading in forex market or in stocks market, it's very important for me as a trader to invest a chunk of money in equities to safeguard from the market risk, because as we are talking about the risk management, this is also comes with risk management. So what I do is, as Bhavin Shah mentioned earlier, so whatever the profit you are making from the trading, keep a small chunk of that in your equities to grow it in the long term. And I do invest some money in fixed deposit, in mutual funds, in equities, and I do trade with like forex market. So personally for me, I think it's very important to diversify your portfolio. It will segregate the risk and it will keep you in the long run for the market.
Bhavin, what is your perspective on the same?
So I think all of us has one common view that diversification is very, very important across asset classes, depending on the corpus that you have and how much you can kind of afford to allocate respective weightages, because your percentage of allocation to which asset class is very important. Of course, like my friend said, that taking a view or having those analysis or taking calls of switching your money from one asset to other, that is part of the dynamic management. At the same time, even if even if you are having a long-term portfolio, still the diversification is very important, because like I mentioned earlier, that all the asset classes doesn't perform at the same time. So one, to manage out and mitigate your risk overall out of your overall AUM that you are handling for your own portfolio, and second is to balance out and take the opportunities of the moving asset class at every time. Like in 2 years, we've seen that gold has shot up so much. Now, if you had not diversified at all, I mean, probably you would have missed out the complete rally. It can be even a 5% of your overall allocation. But equity, of course, until now, it has been globally proven that is the best performing asset class over a period of time. Real estate, fortunately, now you've got REITs where you are able to take some exposure on a retail level also. So I think whatever options are available, one has to assess and have the right proportion to your portfolio so that you are able to capitalize on the opportunities at what each time the asset classes are performing. And it also helps overall mitigating your risk volatility also.
Nice. I have one more question for each one of you. Like, what are the strategies to be kept in place to avoid the risk management, to take care of the risk management? Like, what are the strategies which somebody can take?
So strategies as in, see, one has to assess your own risk profile and risk tolerance and risk affordability. Once you are more or less aware about it that, this is kind of a capital drawdown that I can afford, this is the kind of capital drawdown that I can tolerate, basis which the strategy has to be decided. Right. So, which asset class, whether the asset class what you are putting or the product or an instrument that you are putting your money, is it a speculative in nature or is it an investment instrument? So, your objective and choosing of instrument is very important. That now I cannot say that you want to invest your money, you take future and options, right? Because the nature of instrument is a trading instrument. It's for speculation, it's for momentum trading. So, it's very important that you assess your own risk profile, understand your risk stage, and then kind of choose the instrument and choose the percentage of weightage in that instrument. So that itself will become the shield to your portfolio. And one should not forget that in the overall aspect, lot of times we are talking of risk management, but there is a different angle to it also, that where you need to have insurance also. So insurance as in the actual insurance, not the insurance to your product, but because that insurance also helps you to kind of do your wealth protection at the same time taking care of the uncertainties. Otherwise, all your planning, your cash flows, everything can go for a toss. So I think these are the few things one needs to keep in mind before building up any portfolios or choosing the instrument.
Rohan, what is your perspective on the same?
So my basic strategies is like when I make a setup or something, when I enter a market, the first thing, like as Mr. Siju said, like economic calendar, that is very important because that will initially give us an idea what is happening in the market. Second thing, I'll check the historical data. I'll see like what was the last 30 days, how the market was performing or particular asset was performing. I will follow that. The third, I'll go with like about the risk management plan I will follow. And the fourth, like I'll have a patience. I will not be the person like, okay, I see a small profit and I'll take it out, but I'll make a proper setup following the fundamental technical factors. So I think these 4 strategies are very important to enter the market prior you take a trade.
Does it matter for investing and trading both, or it's a different parameter for each?
I'll talk more about a trading parameter. Like even if you talk about investing, it's same. Like if I invest in something, I will check like how that particular market is performing, and then I will take a call.
Siju, what is your perspective on the same?
So we used to run a proprietary trading group, and one of the things we would require, so we would take and incubate new traders, right? We would teach them market fundamentals, we would teach them technicals, and then we would teach them different strategies. But before you can trade, you had to have a trading journal, right? So you have to write your rationale for the trade, your entry point, and more importantly, your exit point, right? So I think that is something that, and we would go and evaluate these traders, because you would see what happens is they would go into a position, and as one of our colleagues said earlier, as the market started getting close to their stop, they would remove the stop, right? And all of a sudden they went from a short-term trade to a swing trade to a long-term trade. So I think, knowing more importantly when you're getting out, right? So we noticed that for our successful traders that pass through the certification programs, having that trading journal, forcing them to write it, and I'm speaking more to a retail crowd right now, is something that reinforced that, right? So we mandated that all the positions have stop losses. But on top of that, there were so many other strategies we had where we had a risk manager monitor them. So they had daily P&Ls. So once you hit the daily P&L, you were cut off anyway. But the most simplest thing that I saw was trading journals. And over time, we ran the proprietary trading group. We had a different program, which was a capital introduction program where, we had hedge funds who were looking for trading talent. And they would come to us and say, listen, you have hundreds of thousands of traders. We're trying to identify the star. And most of the time, what they would ask for was, their investment and their trading rationale. And if you couldn't clearly articulate, then the assumption was you were just a gambler and you got lucky. So the simplest low-tech thing that I've seen is, a trading journal where you can walk me through why you made the decision, and more importantly, where your exit was.
Okay. Rahul, what is your perspective on the same?
So what I think is it's a very subjective topic. So basically the risk management part, it's basically dependent about as Bhavin Shah mentioned, risk appetite of the client or the investor or the trader. How much they are willing to risk. For some people, $1,000 is a big money. For some people, $1,000 is very small money. So like whenever they are trading in the market, they have the idea that this much amount they can risk, and as per they need to plan. So it's very important, as I mentioned you, while you are trading, to follow the discipline, that if you are riding a trend, if you are in the right side of the trend, then book the profits, and if you're on the wrong side of the trend, then cut the losses and wait for the right moment. So these are the basic strategies we need to follow while you are trading in the market.
So I think one more can be added, like if somebody wants to trade into the market, they can create one trading account and one investing account, so that it won't, create
what I am telling you from the trading perspective.
Okay.
Yeah.
Now I would like to understand, like if somebody from the audience built a, a portfolio of 100 crore, so how they should take care of their risk management on the same? Anybody would like to give their perspective on the same?
So I think it'll probably all the comments gets summarized here. Any portfolio you are constructing, first of all, the holding period, the consistency and discipline is very important. Along with that, the diversification asset class, selection is very, very important. So I'll be a little more specific in terms of the example or the number you're mentioning about 100 crore. There, what will happen is my priority will change there. My priority will become first will be capital preservation and then the capital growth. So, because then I should be happy with even 12%, 13% rather than running behind for 18%, 20% CAGR, right? So my choosing and selections of instrument, the strategies, the theme of the portfolios will probably change a bit there, and I might get little less aggressive. Yes, partly some fund allocation can get into little speculative trading momentum strategies where you can have that alpha over the overall portfolio returns. But I think largely my priority there probably will become, if I would have been there and if I would have 100 crores where I have to plan my investments, I would first look at a capital preservation and the quality of the portfolio, and then probably allocate some 2-5%, 10% of the overall corpus for a trading or momentum strategies.
So probably you will incorporate all the key principles, like when you invest
Yes.
in growth investing and taking care of the trading part also.
Correct. And I feel this factor should be structured and incorporated for every retail investor also. Maybe you are starting with say 10 lakhs in the investment, you have got investable surplus. You start incorporating these principles and rules from day one. Then what will happen that your portfolio construction over a period of time, you will find it more healthier in nature, right? If you try to look back 5 years back, that what you did, you will find all mess things and you will have no clarity कि मैंने because मेरे को इसने बोल दिया ये ले लो, उसने बोल दिया ये product ले लो, उसने बोला ये scheme में डाल दो, and you will have no idea, because that is the most typical thing and the myth that one needs to understand, that don't follow herd mentality.
On the same perspective, I want to understand from each one of you how to take care of the systematic and unsystematic risk on the same.
So when you say about systematic and unsystematic risk, systematic risk is something where you follow all the basic things before you enter the market. As we started with risk management, economic calendars, don't follow the trend, go with proper fundamental technical factors. So these are the systematic. Unsystematic, I can say कि one called me and say, okay Rohan, ये देखो stock perform कर रहा है, gold पे opportunity ले लो. So that is unsystematic risk. Second thing, as we see today, like everywhere, the social media, we say Instagram or YouTube, all reels coming in, like becoming a trader. If you follow those trends, of course, that is unsystematic, because you are taking a risk of your hard-earned capital. Not like we don't have a plant at home where we take any kind of risk and we enter the market. So these are the basic.
Okay.
So I was thinking about the earlier question you asked about if you run the portfolio. So as a broker, particularly, prior to ATFX, I worked at a company called FXCM, right? And we were a casualty, I would say, of unsystematic risk, right? So we were handling client positions, and our positions grew, and we have a trading desk that monitors that positions. And we learned a big lesson afterwards, which was we were heavily exposed into the Swiss franc. And all of a sudden, the Swiss National Bank cut. They were pegged, and overnight they cut. And we suffered a $350 million loss in a matter of 15 minutes, right? Oh. So the takeaway from that was, of course, we had very large positions. Certainly, we did not have the proper hedges on, but more importantly, when you get to a portfolio and positions of that size, liquidity becomes even more so, right? So I think, when you talk about unsystematic risk, so one, again, the known unknowns. You don't know what you don't know, right? So of course, the systematic ones in terms of economics, you have economic calendars that can follow what you need to do. But when you look at your portfolio or when you look at your book, running through, for example, today, what our risk managers do and what our chief risk officer does is runs through stress testing on the portfolio, on the books, to liquidity, right? And three, I think very important for retail and institutional investors, and I talked about this yesterday in my keynote, one of the biggest risks is your counterparty risk, right? And institutions do this all day today because they're very wary of where they're holding their funds, right? And I think retail investors also have to be very sensitive about that, right? And so the worst thing, especially for a retail trader to do, is it's challenging enough to make profits in the market, but then to find out that you cannot withdraw, right? So being aware of which broker or which counterparty you're trading with, where your funds are being held, what licenses they hold, and then what recourse you have. So not just market risks, but again, counterparty risks that sometimes is the unknown.
How you will categorize the risk of Trump?
I'm interested. Yeah, it's interesting because I'm Indian. I was born in India, but I'm a U.S. citizen today, right? Again, he was great for the market. He was good for, but it's not unsystematic in the sense that I think going into the election, I think most pundits had him winning, so I don't think it was a surprise. So yes, unsystematic, but at the same time, I think all my colleagues that are on the crypto side of the world, they're very happy about these things. Others maybe not so much.
So I think we had a very wonderful session today, and probably everybody would have understood about how important it is to take care of their portfolio and how to take care of their risk in their portfolio. Any questions from the audience side we could take?
Yes, do we have any questions? We're open to take just one question since we are running a little late. So anybody in the audience who like to share any question, any thoughts? Okay, can we quickly pass the mic there?
My question to CG Daniel sir, how do you hedge your position while trading in crypto?
So no different than any other products. You have multiple different venues. You have exchanges that you can hedge off of. You have market makers they can use. You can use futures. You can use perpetual. So I think the crypto market is also quite developed. I'm speaking purely from an institutional perspective of how we hedge our exposure, but a lot of that is also available to retail clients today as well.